This is the Daniel Mesrobian Experience, your associate broker with eXp Elite Builders. This is a podcast we're going to be doing to really help the public understand and know and just gain some knowledge on real estate, everything real estate related. How's the market doing? How's my local market doing? Is it a good time to buy? I'll go into a little bit of myself, my background, how I got here, and hey, why would somebody like you want to listen to this? How this information can help you with regards to purchasing real estate, selling real estate, and really just at the end of the day, I mean, why do we all do it? Generally, we're trying to do it to create generational wealth, and I have had the good fortune over a number of years to help people do that, and the reward that comes with that is, you just can't be put into words, the level of gratitude I have. So we'll talk about that as well when we get into why we do what we do as far as real estate, how it's going to benefit you, what position you're in, what your motivation is with regards to why you're selling, why you're buying, things of that nature. So first and foremost, so we'll talk about me. I am, again, Daniel Mesrobian. I am an associate broker with eXp Elite Builders. I've been in this industry right out of college since 1999. I took a job. I actually was a history major in college in New Jersey at Montclair State, and took a job with a mortgage company in 1999, right out, Champion Mortgage. A lot of you people might remember them. When your bank says no, Champion says yes. From there, I went to, so at Champion, basically what I did was I learned everything there was to know about mortgages. I didn't know a thing about it. My college major was history, if you can believe that. I was going to come out and teach, and once I got done with college, which was a very, very hard struggle for me, it took me 5.5 years to get a 4-year degree. So picture that. Was on academic probation twice. The dean actually put me in his office and said, do you even want to be here? Like, why are you here? Finally graduated in 1999, and they must have sent my resume to Champion Mortgage, because they called me and said, when I came in for the interview, they hired me on the spot and said, I said to them, listen, I don't even know what a mortgage is. And they said, don't worry about it. We'll teach you. They did. And 3.5 weeks later, I knew everything I needed to know about what a mortgage was, how they are originated. And then I closed them, originated them, underwrote them, and also funded them. So, but the funnest, Danism, the most fun part of the mortgage part was underwriting them, because everybody has a story, and as an underwriter, you're trying to find out why. Number one, why someone's credit is what it is. Number two, why there are gaps in employment, why their credit is low, why their credit is good. Things of that nature. So the detective work I really appreciated and enjoyed. So that gave me a great background on it, and that helps me a lot right now when it comes to helping a client, somebody looking to purchase, and they don't know how much they need to put down. They don't know, if their credit's going to be in the top tier, middle tier, low tier, things like that. So I can help guide them, and this background that I have has really helped me with that. So from Champion, I went to a company in West Orange, mortgage lender, where I actually met my lender right now. Good gentleman of mine, good friend of mine named Dave Sachi. I met at a lender in West Orange. We worked together there. Some crazy stories we can, about that experience. And then from there, I went to Johnson & Johnson's credit union, underwrote the loans there for the credit union members. From there, I went to Franklin Credit, which was in Tribeca. I worked in Tribeca for about 2.5 years. And then from Tribeca, let's go to 2008, when the mortgage crash hit. the biggest issue with that was loans that were being sold on the secondary market. They were being so picture 1,000 loans, mortgages from homeowners. They get pooled into this large pool of securities, and then those securities are then rated by rating agencies like Moody's and agencies like that. They put a number on or a grade on it. A paper, A minus paper, B plus paper. The more risky the loans are, the lower the grade, and then because of that, the profit on selling those is higher because the risk is higher. So you're getting them at a discount. Well, they leveraged. So say, for example, this one pool of 1,000 mortgages is, I don't know, they borrowed $1,000 against that. Well, the problem was they leveraged that like 30 times over. So instead of, if that pool fails, you're out $1,000. If the pool fails, and by fails, it means it defaults and those people stop, they can't pay their mortgage. If that pool fails, it's not $1,000 that is lost. It's $30,000 that's lost. So I was involved in that as far as grading out mortgage pools when I was at Franklin Credit. And then from there, I went to Interthinks in the late 2000s to do fraud investigations for a lot of these lenders that were putting together loans they shouldn't have. Kind of like The Big Short. If you ever saw the movie The Big Short with Steve Carell and Christian Bale. God, it was a phenomenal movie. And when they break kayfabe in that movie and explain to you as the consumer what they're talking about, credit default swaps and collateralized debt obligations, somebody who's not in that industry wouldn't know what that is. So they did a great job with explaining that movie. Sidebar, I was doing acting at the time too, and I was in the city bartending. And this was around, I want to say 2009, 10, 11, in that area. And I was doing an overnight shoot in a courthouse in Queens because we had to rent the courthouse out when it wasn't open, which was overnight. And it was this insane scene with, it was a bondage scene in the movie. And I ran into my friend, and he was there and said, you should get your real estate license if you're going to be pursuing an acting career. And I never thought about it. And then I ran into him about another year later. I didn't get it. And he said, you're nuts. And then running into him again for the second time was the straw that broke it, and said, you know what, I'm just going to go and get it. And then it just morphed from there. I became very successful at it. But I also was in proximity to a lot of people that have helped me over the years. I always say there's never any rich hermits. So people that are there that are very successful themselves, you'll find that a lot of them like to actually help and share their knowledge and wisdom with others that are beginning. So now we'll kind of foray into like, why listen to me? Like what is my purpose here of starting a podcast and talking to the public? And really, it's just I am so grateful for the people that I've helped and the knowledge that I have. I just want to share it with you in hopes that you, as the person listening, can take this information and say to yourselves, all right, now I'm armed with something more than I had before to make a really good decision about whether this piece of real estate's a good one to buy, whether, I should rent here, I should buy here, I should sell. If this podcast is going to be all about that, all about real estate, the market, buying, selling, really anything to help you maximize your experience with it, where whatever you're looking to accomplish. Everybody has a different motivation to why they're doing what they're doing. And I run into that every day when I talk to clients and new prospective clients. Mr. and Mrs. Seller, I noticed your home's on the market, was on the market. It didn't sell, but it looks like it's in a great location. Looks like it's in great, good condition. Share with me, was there a particular reason you were even looking to sell it in the first place? And now you're going to get into why somebody is doing what they're doing. And that's the most important thing. It's not anything else as to they had a goal. The goal wasn't achieved. Okay, why not? What happened? And then what we can do if their expectations are something we can achieve, how we can help them actually get that. So We're gonna talk about how we create generational wealth. I mean, real estate is one of the only things, like one of the only bastions in like this country where you can buy something at a lower price here and experience appreciation, and then sell it at a much higher number and actualize that gain. Stocks are probably the only other thing you can do that with. So stocks in the real estate market, like I don't know any other thing you can do that you buy it here at a lower number, sell it here at a higher number, and you can keep doing that over and over again if you know how to work the cycles. So I'll help you, and I've helped people do that. I'll help you get the knowledge you can to create that generational wealth, because I've been doing it for clients for Lord knows how long. So now let's get into some content. Let's get into it. Where we are now. Where are we now? A seller's market, a buyer's market. Do that. So from 2010, 2011 to now, you're looking at about 10, 11 years. Real estate generally runs in 7 to 10 year cycles. So knowing that, then the pandemic, with this pandemic really kind of threw things for a loop, because I don't know if anybody, like the frenzy that we've seen in the market, sellers and buyers and people wanting to move and get out of the city and get out of urban areas. I don't think anybody could have, predicted that. So that for the last couple of years has been a seller's market. God bless the sellers that took advantage of it and realized the gain, because I've never seen anything like it. I don't know that anybody alive has, but that was then. We are in a much, much different market now. This is a definite market where you are seeing, instead of multiple offers, you put a property on the market and you price it, where properties are trading, you're getting, 8, 9, 10 offers. Now, that price the market that's trading at that specific number, we are seeing like high levels of downward pressure in the market from factors like inflation, factors like the interest rate market going up from 3 to 8 in one calendar year. We'll talk about that in a little bit. Things like that, the supply chain problems, this all contributed to the market doing a complete 180, huge 180. And literally this year is when it started. Now let's go back to the Fed funds rate. Now, this is the rate that banks lend each other. Okay. So the rate that banks in the United States lend to each other is the Fed funds rate. So by raising interest rates, the Fed makes it costlier, more expensive to take out a loan, which I'm sure you guys are all seeing now. The Fed funds rate in the beginning of the year was obviously much less than it is now. It basically will cause people to borrow and spend less money because money's more expensive. So it's kind of like, if you can visualize, like the Fed is pulling the brakes. Like, remember those old trains, those old like locomotives? And when they needed to stop, this engineer just like pulled this huge brake back and tried to stop the train. That's what the Fed is doing to the economy. They are trying to pull the brakes on the economy by slowing it down. How do you do that? You raise the amount of raise the interest rates, so money is more expensive. Now, the good that comes with that is that it's better to earn. So you're going to get a better rate at your bank, or an investment account, because that's based on, these rates, because now money's more expensive. So you'll get a better, earning rate. But if you're going to borrow money, it's more expensive. So that's the downside. When rates are lower, it's a better time to borrow, but not a good time to earn. So I'm going to share an opinion on where we are at right now with the rates where they are, and the question of, should I buy a home? Back in 2020 and 2021, when I was working with clients, the biggest complaint I had from buyers was, I can't buy the house. I can't get it. I keep getting outbid. There's 15 offers on this property and I can't get it. Well, why is that? Let's talk about why that happened. So that happened because almost everyone could afford a mortgage. Even with 3% down, 5% down, you had everybody putting these offers in, no contingencies, things of that nature. So the competition to purchase was so high because so many people could do it because the rates were so low. Everyone thought this was a great time to buy. And they were right. It is. I mean, it's a good time. And for the sellers, it was a perfect time. Think about it this way now. Now rates are higher, okay? Everybody is pulling back, just like the government wants. They are pulling that lever back and saying, we need the economy to slow down. And Powell even, look, your Fed chairman, Powell even said, like, real estate's going to be affected by this, and we need to basically rein it in. He didn't use those words, but he's trying to slow down the real estate train, which we know. So now, yes, your rates are higher, but there's eminently less competition for the home that you want to buy. Is it more expensive to purchase it? Yes. So if the payment is within reason and you can comfortably afford it, that is one thing that I will never do. Is I'm not going to put anybody in a position to where they are stretched financially to purchase a home. We will look at, because I have a mortgage background, I can go through this with you as an associate broker. I'll go through this with you as your agent or broker. What can you comfortably afford? Okay. And then whatever you can comfortably afford, if buying that home at a higher rate means you can, I'm saying purchase the house. You may have somebody else in competition with you, one other. But right now, very little people are buying because of the rate market. So grab that home. And then in 2 years, 3 years, because we know with certainty when inflation's going to come down, because this is what they're trying to do. The government is trying to rein in the economy. So those inflation numbers that are 8, 9, 10% now, which doesn't even include housing. Those inflation numbers don't include housing. So when those come down to those normal levels they want, normal, 2%, 3%, rates are going to come back down too. Just refinance it. You can just refinance your home. But you own it now. You got it. You already have the asset, so to speak. Whereas before, you couldn't even buy it because you were getting outbid by $50, $60, $70, $100,000 by these buyers that really wanted it and that could afford it. Now that rates are higher, now you can afford it. If the payment is something that you can comfortably deal with. I will always preface this opinion with that. Lenders will look at what's called the debt ratio. Okay. So I'm going off the cuff here a little bit. So a debt ratio is this. There's two debt ratios that a lender is going to look at. They're going to look at your overall debt ratio, which is the money you have coming in versus the money you pay out to bills. Okay. So they're going to look at the overall debt ratio. Then they're going to look at your housing debt ratio. Okay. So there's two of them. Your housing debt ratio, comfortably, if you're spending any more than, I'd say like 35 cents on the dollar. So for every dollar that you earn, they don't like if you're going to be spending more than 35 to 40 cents of it on housing. And by housing, I mean mortgage payment, taxes, insurance, and if you're buying a condo, HOA fees. Okay. So they're going to focus on that. Then your overall debt ratio, which is all of your bills. And by bills, I mean car payments, student loans, credit cards, personal loans, things of that nature, or other mortgages you have. That's basically what they're going to be looking at. Now, that ratio, if you're spending any more than I'd say probably 50 cents of every dollar on that, now you can push above that a little bit if the underwriter of the lender knows that maybe a payment's going to be coming off your books soon. Whereas like you own a car and you have like 6 payments left. Well, after that 6 payments, maybe that's $600 a month. Now you have that for your, in your pocket. They'll look at that and say to themselves, well, this person's going to be in a better position maybe in 6 or 8 months. So we'll overlook that payment because it's coming off. So this is what a lender is going to do when they're looking at your scenario as far as how much they're going to pre-qualify you and pre-approve you to purchase. So just, again, I'll encourage and again, this goes back to motivation. Why are you looking to purchase? You're looking to start a family and you want to get out of the apartment you're living in? Are you your job's relocating and you have to sell, or you're buying in another area? We'll focus this part on buyers for now. So if you're looking to maybe you're the home, just you want to get into a different area, you don't want to be in the area you're in. You're in the city and you want to get out to the burbs. Whatever the case is, this is what a lender is going to look at as far as how to pre-qualify you. Man, the time has come. I am so pumped and excited. I love buying real estate when I find good deals. It just gets like my juices going. I'm going to be sharing with you